Hey all, this is Sandeep. In this video, we will talk about 401ks and I'll give you a dollar by dollar comparison and a reason why, if you do a 401k, why you will end up with more money at retirement than if you do not do a 401k. So we'll look at a detailed example of how that will play out. I did want to make this video because there is a lot of people out there who will tell you, hey, you should do a 401k, it gives you a lot of tax benefits, but they do not go into the detail or they do not give you a dollar by dollar comparison of how that will work out and why you would end up with more money during your retirement if you do a 401k. And there are also many people out there that will tell you that no, stay away from 401ks. This is a government scam and you lose all your money and you lose control and all of that. So I look at all of those reasons why typically people say do not do a 401k, and I will debunk all of those reasons for you in a minute here. Specifically, I will show you how a 401k will let you take advantage of the tax savings that you get today and use those tax savings to earn compounded interest and returns on those savings over the course of several years, and how you will end up with more money in your pocket at retirement because of that option. So stick with me till the end of this video. Now, I'm generally not a fan of this retirement savings mindset. I think it's the wrong mindset to begin with, where you think that, your life is roughly divided into your working years and your retirement years. And your working years are you work for a corporation and make some money as your salary, and then you just invest so that you can live like 20, 30 years of your retired life in peace. I'm not a fan of that kind of mentality because it puts you in this rat race sort of thing. I generally think that everyone should be thinking on a non-stop basis, no matter how old you are. The earlier you start, the better, but you should be thinking about how you can make passive income with the money that you have, even if it's less or more, it doesn't matter. If you have certain savings, how can you get the best return with a risk that is comfortable for you? And you should always non-stop be looking for different options where you can make the return that you need. And that applies to whether you're working, you have a job on the side or not. You should be thinking about that all the time. You should be thinking about it during when you're retired as well, of course. However, I do think 401ks and IRAs and other tax benefit retirement accounts do give you an additional tool for your financial planning so that you would take advantage of those tax benefits, which otherwise you are just leaving on the table and giving it to the government for free. So stick till the end of this video where I'll walk through an example of how you would end up with more money. Now, of course, this video only applies if you have a job, because 401ks are essentially offered through your employer. So if you are a small business owner or you don't have an employer, you're not an employee of a corporation that does not offer 401ks, then this doesn't apply to you. But the same principles do apply to any sort of retirement investing accounts like IRAs, for example. We'll talk about Roth IRAs in a different video, but all of those options do offer you some sort of tax savings and benefits and the kind of power charging that compounding of returns offers you. So all of these principles would apply to those accounts as well. So before we go into the comparison and into the financial model that we'll build here together, why do people bash up 401k so much? What are the common reasons that people suggest that 401k is coming from the world of evil? So I'll go through these reasons one by one and debunk these for you. So the first reason that many people say that 401ks are not good is because they say that you will lose control of your money when you put your money in a 401k. Now, this is total baloney. If you have a 401k account through your employer, the employer usually has a tie-up with one of the financial institutions like Vanguard or Charles Schwab or Fidelity, where you would have a 401k account and your money from your paycheck on a paycheck by paycheck basis, whatever you're comfortable with, that amount will be directly deposited to that account. Once you log into your financial, like the Vanguard or Charles Schwab account, you will be able to see your 401k balance, how many contributions were made, and you have a range of options there for you to invest in. You can select a range of funds where you want to distribute your money to. And these funds range from very safe government bond specific funds that usually have a low return, but also a low risk, all the way to high risk international markets, stock markets, equities, even real estate, REIT funds kind of thing. So there's different kinds of mix of funds that are available for you to invest in depending upon your risk and return appetite and profile as such. So when they say you lose control of your money, I think that mischaracterizes what 401ks do. It's not like you're giving your money to someone else to manage for you. You have total control of where your money goes. Now, do you have all of the investment options that you would have outside of a 401k? No. So for instance, there is no certificates of deposits that you could do through a 401k. You are not going to be able to just keep it into a current account or a savings account, which pays you next to nothing in terms of interest. So your money is actually going down because of inflation. So those kind of options will not be available. But generally speaking, anything in the mid-range of a risk and return profile that most people who will be comfortable with investing in would be available enough. Another reason that people would tell you not to do a 401k is that they'll say you lose access to your funds till you are 59 and a half years old when you retire. Well, hello, that's the definition of retirement savings. You want to put a certain amount of money aside from your paycheck today so that you can invest it and reap the benefits when you retire. That's why we call it retirement savings. So you want to be able to carve out some money and keep it aside and not use it for your day-to-day expenses right now or your investments or like outside, side hustles or whatever you have. You want to keep some aside and earmark it for retirement. And that's one of the ways that 401k lets you do that, along with IRAs and Roths that you might want to do. Additionally, when you do invest in a 401k, you can always take out the money from Fund A and put it in Fund B whenever you want to. You can log in and redirect your funds, redirect your money between different options, investment options at any time you want. You can earmark your contributions to go into certain funds. So you have a lot of control in terms of what you can do in the 401k. Another argument that you will frequently hear against 401ks, especially after the 2008 financial crisis, is that the value of your 401k might collapse by the time you retire and you may not even be able to retire. Now, this I think is a misplaced argument. This doesn't just apply to 401ks. It applies to any investments in general. Every investment comes with a return and it comes with a risk. And each individual, you have to figure out what is the return that you're looking for and what kind of risk you're comfortable with. As the return goes up, for example, savings or bank would be the lowest, maybe certificates of deposits, bonds, and then stocks and the real estate. That's kind of the scale of the returns. As this goes up, this doesn't stay at the same level, which is the risk. The risk is also going to go higher as you seek more and more returns. So every investor has a different kind of appetite for what risk they are comfortable taking depending on the balance of their portfolio, etc. This argument doesn't apply to 401ks. It applies to any sort of investing in general. So if you are just buying a stock outside, this would apply to that as well. So I think 401ks just get bashed up with this kind of argument. The reason being 2008 was just a widespread impact that every investor in the world really felt. So I think it's an unfair argument against 401ks. Now, some people also argue that a 401k is not good because it does not let you invest in high return investment options like real estate, for example. Like I said, with a higher return, your risk also goes up. So do you really want to put all your retirement savings into an investment option that gives you higher returns and risk a lot? Because these are, after all, your retirement savings. So you'll be relying upon these. Hopefully you're not relying too heavily on these. It's just one tool in your belt of financial planning, but it's an important tool that you'll be relying upon when you retire. So you do want some options where, the returns are high, and high enough, but not so high that they will also ratchet up your risk on the other side, and make you lose all your money close to retirement. So it's the same people. I feel like they're talking out of both sides of their mouth. On one hand, they're saying, I can't take a lot of risk with my 401ks and with the high return investment options. And they are also saying, look what happened is 2008 and everybody, you could lose all your money in a 401k. So it's kind of a contradictory argument. But for an average investor, you'll get reasonable options where your return and risk will be balanced for your specific risk appetite. Another argument that you'll commonly hear is that if you put money in a 401k, it will be invested in some sort of fund, and the fund managers would reap hefty fees from your money. Now, these fees, that's while this is true for most in mutual fund options, index funds are a good option to circumnavigate around high fees on your funds. Index funds typically, historically, they have returned an average of 10% returns, not accounting for inflation, and their fees tend to be less than 0.1% of the funds, which is basically less than a dime on every $100 invested. So also think about it this way. If you have the option of investing your retirement money in a bank which only pays you like 0.8% per year interest, versus another option where you can put your money in slightly higher risk but higher return investment, and that gives you, let's say, conservatively 5%. Now, index funds historically have given back 10%, but let's be conservative here. Let's say you have another option which gives you 5% returns, and 1% of that, or 1/5 of the total returns, is taken up as fees. You still end up with more money in your pocket than you would if you just stay invested in a CD. So fees are not all that bad as long as you are making more money by choosing that investing option. Now, just to be clear, I'm not saying that 401k is some sort of silver bullet that everyone on planet Earth should go for. It has its limitations. For instance, you don't know what the income tax rates are going to be 20, 30 years from now when you retire. You have no control over that. Also, you don't have specific investment options. You can't invest in a specific stock or a certificate of deposit in a 401k. So it has its limitations, but with reasonable assumptions about past data and making those assumptions about the future, 401ks allow for a very useful investment tool. Now let's look at a very short example, and let's build this small example together of how 401ks will let you end up with more money during your retirement. Okay, so let's start with this short demo of sorts of how you would end up with more money if you do invest in a 401k. So let's assume that you're starting with $1,000 in this case. So what I'm going to do is let's just start with $1,000 in each case. Let's try and compare 401k. So this option is when you're investing in a 401k, and this is let's track no 401k option or scenario over here. So those are our two scenarios that we'll try to model. Now, let's start with an assumption that we are talking about $1,000, and then we can scale it up and down based on whatever amount you want to plug in over there. So let's assume we got paid $1,000 by my employer, and now I'm going to play out two scenarios. One is where I invest in a 401k, and one is if I invest outside of a 401k. I'm going to assume I'm going to make the same investments in both cases with the same returns and risks. Just one scenario is through a 401k and one is not. So if you are doing a 401k, you get to, and this, we'll assume that this is a pre-tax salary, okay? And let's assume that your tax rate, and this is a blended tax rate, is going to be 30%. So if you have that as your tax rate, with that tax deducted from your salary, you will have a post-tax amount left of $700. Now, this is in a non-401k situation. If you do invest in a 401k, you can tell the government, hey government, I'm going to put this $1,000 into my 401k, so it has to be pre-tax, so do not tax me on that money right now. I'm going to invest it in a 401k. I'm going to grow on that money, and when I do withdraw it when I'm retired, that's when I'll pay you the taxes according to the rates at that time. So government says yes, fine. Okay, so we have the full $1,000 invested in the 401k. If you invest outside of a 401k, if you're not doing a 401k, then government will tax you for that $1,000. So basically you will be getting a $700 from that money to invest in any investments that you want to do. For the sake of comparison here, I'm going to assume we're investing both of these amounts in the same kind of fund. right? So let's assume that the return that this fund would give you is 8%. Okay, or let's assume 7%, for example. So that's kind of the average return of an index fund, accounting for inflation, that you will see over the last like decades. So let's say with this 7%, what's going to happen at the end of year one here is your money is going to start out with the principal amount which you've invested, and then you will get a 7% return on it. So you simply multiply it by 1 plus that interest rate, and your $1,000 in a 401k would essentially become 1,070. So that's a 7% return on your $1,000. Likewise here, the same formula can be applied to $700, and I think we should anchor this 7% here. All right, and there you go. So now I can copy this over, and here you go. So you would have 749 at the end of year one. Now remember, the difference here is that here you have deferred the taxes. So when you do retire and take this money out, you're going to have to pay taxes to the government, which in this case you already paid the taxes on your 700. So you will only need to pay taxes on the $49 that you made if you were to withdraw this right in the next year. However, let's assume that you're young right now. You will be investing for a bunch of years. Let's say we calculate this over 20 years. You're going to retire 20 years from now. Let's see what happens to this compounding interest rate over here. So this is going to be the value of your investment every year. So let me just remove the decimals so that gets rid of the clutter a little bit, and you just see the dollar amount that your initial investment is going to be what I'm going to call this a year zero. So as you can see, your $1,000 that you did put in a 401k pre-tax has, at the end of year 20, it has become 3870, whereas the $700 that you put outside of the 401k has grown to 2709. Now, obviously, this is less than the 3870. However, remember that all of this money is taxable because you have deferred the tax on it. Now, let's do that calculation. Let's say year 20, you retire, and now let's say you take all of this money out in your first year of retirement. Now, there are limits to how much contributions you can take from a 401k. There's some minimums and so on. But let's assume you take all of this out in the first year of retirement. What will happen is you're deferred the tax, so you never paid taxes on the $1,000 to begin with. And the way 401k works is you'll be telling the government, I need all of this money for my retirement. Go ahead and charge me tax and give me the remainder that will be in my pocket for my expenses now that I'm retired. We will assume the same return rate here, the tax rate of 30%. Now, typically when you're retired, if your overall income is low, you might be in a lower tax bracket and your rate might be lower, or depending upon how many investments you're made, if you're real estate, etc., it might be higher. But on average, I'm going to use the same blended rate that you have right now for when you retire. So the tax paid at retirement to the government is going to be 30% of all of this money, because you have not paid taxes on the principal and you have not paid taxes on the return. So all of that will be taxed at the same 30%. So you will pay 1160, roughly that much in taxes to the government, and then money in hand is going to be all of this balance minus what you paid to the government. So you end up with $2,709 in your hand during retirement for your retirement expenses. If you don't do a 401k, what happens here? You remember the $700 that you have invested here, you have already paid your taxes on those. So you will not be paying any taxes on that part of the money. However, you will be paying taxes on all the returns that you have made in this case. So your taxes here that you'll pay to the government is going to be only on the income or the returns that you got. So that is going to be the 30% tax rate multiplied by this whole amount minus your original 700 that you already paid taxes for. So that's going to be 602 in taxes, and the money that you will have in hand is what the balance of your account is minus what you pay to the government. So you will end up with 2106. Now here, this is where you can clearly see how you end up with more money in your hand doing a 401k than without doing one. And where does that extra money in 401k come from? So that basically comes from the $300 that you told the government that I'm not going to give it to you in tax today, but I'm going to invest it somewhere. I'm going to make money on it year after year through the power of compounding. And of all of that money that I make with that 300 extra bucks, I'm going to give you the 30% when I retire. I'm going to keep the lion's share of 70% of that money for myself. And that's where this difference in these two amounts come from. So you can see this difference in this case here with the $1,000 that we started in, is 600 bucks on the $1,000. So which is basically a 60% return on those $1,000 over the course of 20 years. So that's where I want to say, this is where you see clear difference in how the tax savings that you get today and the power of compounding will make you end up with more money during retirement if you do a 401k versus if you don't. Now, of course, there are assumptions we are making over here. We are assuming that your tax rates will be roughly the same. We are assuming that your return would be 7% year after year, and the returns for these funds could go down and up and down. It depends on when you get out and when you retire. But with reasonable assumptions, this is what you'd expect to get more if you do a 401k. Now, one thing I have not even mentioned in this example over here is the match that I get from my employer. For instance, I get a match of roughly $1,000 or $2,000 from my employer. So if I get a match of $2,000, if I simply plug in $2,000 here, and that goes straight to my 401k from my employer, not from my salary, not from my pocket, but from the employer's account. And that $2,000 in the 401k account is going to put $5,418 in my hand. Every year, I'm going to make that much. So this money, the 5418 that you see here, is essentially what I'll be leaving on the table. This is free money that I'm going to get during my retirement because my employer matched my 401k contributions. If I don't do that, I'm just going to leave all of this money on the table during retirement. Now, this is what we started with, $1,000. You can plug in your own numbers. So guys, hope that comparison of the little model that we built together helped you really understand why you would end up with more money if you do opt for a 401k. Of course, we made some assumptions about tax rates and return rate that may be different for you depending upon your situation and your risk appetite, but you can easily plug in your comfort level numbers into that model and see what that savings looks like for you. So to recap, max out your 401k, invest as much as the government allows you to, assuming, of course, you have enough money left over from your paycheck for your day-to-day expenses and any emergency funds and things like that. If you are not able to max out your 401k and invest the full amount, I would recommend at least try to contribute enough to get a full benefit of the employer match that your employer provides. Find out what that is and make sure you at least contribute that much so that you're not leaving free money on the table. Very importantly, once you have your 401k set up, make sure you log in to the 401k, look through some of the options of investment funds that you have over there. Look at the fee, which is called the expense ratio. There's not a lot you have to read. You'll find like a big document for every fund that talks about a lot of things. Look at the top few investments in that fund. Look at the expense ratio, which is basically the fees that the fund managers charge for you, which will be low for index funds, by the way. If you don't want to go and look at a bunch of funds, you can just look for a S&P 500 or a market index fund and just decide to invest there, because you will find that the expense ratio for that one will be lower than most of the funds. Many 401ks also will offer you a target retirement fund. So if you are going to retire in 2050, there will be a target retirement 2050 fund, which basically simply what that fund does is right now, because you are 30 years from retirement, you'll be heavier in the higher risk and higher return investments. So it kind of auto rebalances as you near your retirement. It will move more and more of your money into safer and low return investments like bond-based funds, and less into high risk ones like stocks. So when you're younger, you're making money. If you lose money in your 401k account, you're still fine because you're making money with your salary, etc. But when you're older and getting closer to retirement, the money automatically kind of shifts to safer investments. Now, the expense ratio for these will be slightly higher than index funds. So if you want to kind of DIY it a little bit to save that expense ratio, you can basically keep it in an index fund right now if you're young, and then 5 years, 10 years down the line, start rebalancing that yourself. You can do that all by yourself in your 401k accounts. So if you like this video, please like, share, and subscribe. You can also post comments down below if you like this video, or you have questions, or if you have any thoughts to share with me. Thank you for watching.